Welcome to the fifth episode of Investment for Beginners. My name is Manuel Maurício. You can find all about my work on allinstocks.com. And Michael.
Hi, I'm Michael Wiggins de Oliveira from Deep Value Returns on Seeking Alpha. I run a premium newsletter that is about hybrid investing, which means you split the portfolio in half. Half of it is value stocks and half of it is growth names. So over to you, Maurice.
Today, Michael, I wanted to talk about an article by Connor Leonard, it talks about reinvestment moats and legacy moats. Moats are something that we all talk about a lot and we hear about a lot. And this, the author Connor Leonard decides to, or looks at it in a peculiar way, very interesting way. It separates a moat in two types of moats, which is the legacy moat and the reinvestment moat. The legacy moat are those companies that we all know about, cigarette companies, McDonald's, Coca-Cola. They have high returns on invested capital, but few opportunities to reinvest that capital back into the business. So they retrieve the cash back to the shareholders in the form of dividends or share buybacks. And then there's the reinvestment mode, which has some of the characteristics of the legacy mode. So great businesses that produce a lot of cash flow if they want to, of course, but they also have the opportunity to deploy that cash at high rates of return. And Connor talks about Walmart back in 1972, when Walmart had only 52 locations, each one of them with great unit economics. And until the time when the article was written, which I can't remember right now, but it's recent, the profits and revenue had gone up 5,000 times since 1972. So what Walmart or Sam Walton had to do was to build as many Walmart stores as he could do it, right? Because the unit economics were great and the addressable market was huge, the opportunity was huge. Now, Connor asks the question, how do we spot a great reinvestment mode? So that's the hard part, right? For some businesses, it's easier, like Walmart, like retail businesses. I believe for me, and this is highly personal, but for me, spotting reinvestment modes in retail businesses, it's much easier than in other companies. And he looks for businesses. Basically, this reinvestment mode makes businesses stronger as they grow. Economic theory tells us that as a company grows and has high returns on invested capital, there will be competition. It will eat away your profits. So you've got to lower margins, et cetera, et cetera. And then there's the reversion to the mean. So what he wants is those businesses that defy the economic laws and defy the reversion to the mean. So inside the reinvestment mode, he also divides in two types of companies, which are the low-cost producers or scale advantages. And the other one is the two-sided network effects. And I'm going to go through these two in not in a lot of detail, but quickly. So the low-cost producers or scale or businesses with scale advantages could be Walmart, like we said. When Sam Walton started building out these Walmart stores, the competition was much smaller stores. So he could purchase from suppliers at much lower cost. Then he could lower his prices. So the competition couldn't possibly compete with that. So that's the low-cost producer or scale advantage. Other examples would be Costco, Amazon, Geico. So then it creates a flywheel. The bigger or the lower the prices, the more clients you have, the more bargaining power you have with your suppliers, the lower the prices, the more clients you have, and so on and so on. So these businesses tend to become stronger as they grow, which is a cool, for me, it was a cool realization. Intuitively, we know about this, but then reading someone putting it so clear was interesting. Another one is the two-sided network. And we have the eBays, Airbnbs, Fivers, Visa as well, the credit card payments businesses, that the more users there are in the network, the more valuable the network becomes to the new users. So let's take, I don't know, eBay. The more people putting ads, putting products on eBay, the better the value proposition for me as a customer, because I will find more things there. The more often I go there, the more people come to sell their stuff. So and what he asks at the end of the article is, why do investors miss this reinvestment mode? Why is it so hard to invest in these companies? First of all, I would say is because they always seem to look expensive, right? If we go through Ben Graham's eyes, through the PE ratio, traditional value metrics, they'll often look very expensive, 20, 30, 40, 50 times. Even we have the unique case of Amazon, which didn't have any profits for a long time, so there wasn't even a PE ratio. So they seem very, very high at any given point in time, which reminds me as well of a presentation that I've just watched this weekend by Brian Feroldi, who was previously in Motley Fool. And he said that what made him miss a lot of great investments was his valuation filter. So he could understand the quality of the business, he could understand the dynamics of the business, but he had such a narrow focus on valuation from traditional metrics that he missed a lot of them. So the title of his talk is something like compelling case for ignoring valuation. It's something along these words. So the thing is, and he wants it, and he showed a graphic that where it goes up and to the right. Let's say that we're looking at a Costco or at Amazon, and it goes up and to the right. And you're here right in the beginning of the ascending curve, but the valuation is somewhere. It justifies the profits 5 years from now or 6 years from now. But the thing is, it goes even higher. The opportunity is so large that you could pay a high multiple today and even so get a great return on your future, on the future. So this was very interesting. I hope you read the article. I'm not sure if you had the opportunity.
I didn't have the time. No, I did not.
Okay.
But I have plenty to add that I'd like to add right away, if I can.
Yeah.
I found right off the bat that it depends very much on the sector. So, for example, consumer businesses seem to be very well known. It's an easy pitch for me to sell you. Like, look at this business, Nike, whatever. Yeah. So it's this business. I don't have to sell you the idea. You see it in the shops, you pass it everywhere. It's a much easier sell. And within the institutions, it's also an easier sell. If I give you a different example and I tell you about an insurer called, I don't know, Geico, it's like, Geico, who's Geico? Like, Geico because of Berkshire, but if it wasn't for Berkshire and I said, oh, consider Prodigy, who the hell's Prodigy? Like, and it becomes like, it's kind of interesting because within these compounders, it very much also depends on the shareholder base that you get and your ability to go after these kind of what you call reinvestment projects. It makes a huge difference. So, for example, you look at a car manufacturer, let's say a Volkswagen or whatever, and it's kind of like, man, we make cars, right? Our shareholders expect us to make cars. That's what we do, right? So that's what we're going to continue doing. We're not going to go into some kind of energy fields or what the hell, man. Like, that's not what our shareholders expect us to do. They'll hold our stock for as long as we continue to develop more cars and sell more cars. And then you got something like Tesla, right? So Tesla, like, how the hell do you value that thing? Like, but they have this team, the culture in there. I know it's a very controversial stock. There's bulls and bears or whatever, but it's the culture in there is that we're not happy with the status quo. We are going to continue just throwing things out, and some things are going to work out and some things are not going to work out. And sometimes it kind of goes down to the wire, and it's like, it's very much depends on two things. First, the company culture. Second, having the right shareholder base. Because these things always look so easy in hindsight, but like the examples that you kind of gave me, as it alludes to what I'm saying, it's like a lot of these companies that you mentioned as well, their shareholder base has been aligned. You know, people knew Walmart in the 70s. They shop at Walmart. It's not a new kind of brain teaser. It's kind of like it's a no-brainer, right?
Well,
I go there
back then it was, I believe, or I would imagine that it wasn't obvious, because it was not the first of its kind, but almost the first of its kind.
But it's an easier sell, right? You go into that store, you visit somewhere, you go to that store, you can visualize it. If I give you something, for example, let's say some of these software companies like Snowflake. Snowflake is kind of like a marketplace in a sense, kind of a two-way system, because the more that companies upload the data, the more that you can retrieve that data, it becomes more valuable. So the example that you gave me is about eBay. You can just extrapolate that to mean Snowflake. So Snowflake obviously has the Berkshire sign of approval on it. That's why it trades at such a high multiple, but it's not that well known like right now. And you look at this type of business and it's like, will they be able to get the shareholders to kind of give them enough wiggle room to not only go with the legacy business, because now it's a new business, so has a lot of opportunity, but at some point it saturates the market. And will they have the ability to kind of go off into different segments? And you pay a very high premium for these investments with the expectation that the management will be able to, and it's a very high risk strategy, this kind of ignored, and it's very popular right now. Right now, 2021, anyone in this business wants to pay up for leading companies. And this is actually something we talked about in last week's episode. It's very easy to pay up for a leading company. And this, like, I'm kind of a bit on the fence on this one, because I look and I see the interest rates are low. And I also look, so over the last 5 years, the S&P has compounded at 15%. And if I go back over the last 10 years, it's approximately 14%. So historically, we have not been able to compound the S&P at 14% over a 10-year period. So it will normalize. It's inevitable. It has to normalize at some point. Yeah. And like whether it's the next 2 years or the next 10 years, at some point that has to normalize. That's just how it works. That's how trees don't grow to the sky. So everybody right now is kind of saying, oh, forget the valuation. It did look at Netflix, always expensive from the word go. Look at that, like it's really was expensive from the word go. Look at Shopify, it was so expensive, and whatever the valuation, you could just pay whatever multiple, it didn't make any difference. And there are these individual case studies, and everyone's kind of basing those individual case studies, what Michael Mobalsin calls the inside case. So you're kind of looking at individual particular cases to justify the whole of the population. The whole of the population is not going to work out like that. There are going to be 3-4 SaaS businesses, or 3 or 4 high quality businesses like Visa, like a firm that will over the next 20 years just kind of obliterate everything. But there are a lot of failures as well. Sorry, I can see you're going to say something. You've
touched some points, and it's interesting how each of us will understand this article and other concepts under the light of our own experience. You've gone to mostly to the examples of the marketplace and Snowflake. I was going more because of my experience and what I feel comfortable with the retail business. And what the article, what the author says is that most of the companies are hard to understand if they have a reinvestment mode, if they're going to be compounders, like 99.9-9 are hard to understand. But then there's some that aren't that hard to understand. And you mentioned, if I don't know if it was Snowflake or other, but if when the addressable market is filled, if they can go into other stuff, for me, the I want to, if let's say that I'm looking for reinvestment modes, I'm looking for companies that don't, the market opportunity is so big and they are so at the beginning of that expansion that I don't even need to think about new segments in the future, right? Let me give you two examples.
Okay, sure.
Let me give you two examples. And I'm not saying these are great investments, but they sure seem like great companies and retailers. Five Below, which is a discounter in the United States. They usually, now they're shifting a little bit the focus, but they sell stuff that nobody wants. They're the first ones to say that. We sell stuff that nobody needs, but they want, under $5, right? So balloons, toys, gummy bears, whatever, a lot of stuff. And The Joint, which is a franchising business for chiropractors. Is that how you call it? Chiropractors?
Yeah.
And both have gone up. They're not cheap right now. Both have gone up a lot, especially The Joint. And I was looking at it when it was at $8. I think it's at $80. And now a short report came and it came down a little bit. I looked at Five Below as well, and I, for some reason, I didn't buy both of them, but it was pretty easy, and I say this quote unquote easy, to understand that both these companies have huge, very good unit economics, and what they should be doing is opening more stores and more stores and more stores, and they had very high chances of becoming compounders. So in relation to what and just to wrap up to what you were saying, these ones I thought they were easy. So these are the ones that I want to focus on. The hard ones, let's just let them pass and let's try to find the easy ones.
So like the example that you gave me, this Five Below. So that's not really a reinvestment mode. That's the legacy business that's expanding forward. Is that right? Exactly.
The reinvestment mode it doesn't need to be in a new segment. It's the same thing. Let's just plow back the profits or the cash flows back into building more and more, so it can keep reinvesting.
Okay, so let me offer this from the other side of the equation. Okay, so there's this company in the US that advertises properties called Zillow Group. Zillow Group, you have a property, you're an agent that wants to list the property in the US. You'd go to something like Zillow Group and you advertise your property and you pay them a certain amount. Okay, so it's quote unquote an advertising business, but it's essentially a business that is very, very profitable. You're paying them for some space on a website and it's doing really well. Okay, but then here comes this other competitor, Open Door Technology, which I do own, so there's this disclosure. And Open Door Technology comes up with this kind of new business model. It's called iBuying. So iBuying is essentially, you have a property to sell. You don't want to go through all the difficulty of listing your property, waiting for it to be repaired. Once it's repaired, you put it up for sale. Then people come and view the property, and down the road, it's a year down the road, and you're frustrated, you're stressed out. With Open Door Technology, you'd go there and they charge you 7% of the cost of selling your property. And basically, if someone comes and views your house, ticks off what needs to be done, and about 5 days later, the cash shows up in your account. Okay, this is a very, very razor-thin margin business,
and with balance sheet risk, and with a lot of balance sheet risk.
No, not so much, because they kind of buy and sell. They don't hold the properties for very long. Yes, that would have been an idea. Yes, I thought so as well. I was very bearish this company when I first looked at it, the first twice that I looked at it, first 2 times. But then someone was very kind to me and kind of just kept on grilling me of questions and questions and questions that I just gave up. And I was like, okay, I'll look at this a third time. And then on the third time, I was like, actually, this actually works out quite well. Anyway, I digress. The point I was trying to make is that with Zillow Group, you have a business that's very profitable and growing. And your shareholders are happy that it's not growing very fast, but it's compounding nicely. There's no surprises, no hiccups. There's no, everyone is happy. The share price goes up. Anytime that the share price keeps going up, nobody is going to ask difficult questions. Doesn't matter. It's a buy and set and forget. Everyone's happy. The problem, the competitor comes up, Open the technologies, and then you're kind of stuck. Do you let these guys encroach in the market of online real estate, online residential real estate, or do you just stay here picking your nose? So the Zillow Group CEO has a lot of skin in the game. So he decides, okay, actually, this is a very strong business, this iBuying. We're going to go and do the same iBuying, okay? So what happens is that they have to reinvest a portion of their high margin business to grow out from zero this iBuying business. And then you're stuck in a problem because their shareholder was expecting to see a very neatly growing earnings per share growth. And then all of a sudden, the earnings per share starts coming down because they are investing for growth. And your shareholder's like, okay, I was valuing this on an EPS growth number, and it's not growing the EPS. So then the multiple starts to contract. As the multiple contracts, then more shareholders start thinking, what's going on? And then people start asking difficult questions. The point is that it's very difficult to get your shareholders to transition with you. And in the case of Amazon, every time that they come up with a new opportunity, even if it doesn't work out, like they had a few years ago, they had this Moat phone. I don't know what it's called, the Amazon Moat phone.
It wasn't fire, it was something.
Yeah, but they sometimes come up with these kind of ideas and things don't work out. Their shareholders love them for that. Every time that you try something and it doesn't work out, they're just like, yeah, try something else. Here's more money. And that's the thing I was trying to kind of, it's very difficult when you
but Michael, but what I'm saying is that these businesses that I was talking about don't need to do anything else than what they're already doing. They don't need to go into another segment. When you talk about Zillow going to iBuying, I remember a story. I think it was Buffett who told this story, which was a shopping center, two shopping centers, the tale of two shopping centers. One of them started built air conditionings, installed air conditioning. So everyone went to that shopping center because it was cool in the summertime. It was warm in the winter. And the other shopping center had to invest in capex, which it wasn't even a growth capex. It was maintenance capex, just in order to install air conditioning, in order to stay relevant in comparison to the other one. What I see in Zillow, and I know very little about this, going to the iBuying is a very shallow moat. So the company couldn't just keep its own business. It had to go to another segment to stay relevant. What this guy, Conor Leonard, is looking for is business that don't need to go to another segment to stay relevant, like a Costco. It's been doing the same thing
for example, years. like a Coca-Cola would be an example, right?
No, that's a legacy mode because Coca-Cola can't it could be Coca-Cola back in the day, right? But Coca-Cola can't reinvest the money now, so it distributes it through dividends.
Okay, so so Coca-Cola looking back in the 80s or whatever. So that's what we're talking about, right?
Probably.
So at that point in time, you kind of paying a high valuation in the hopes that this runway doesn't slow down anytime soon, because you're paying many times years future growth profits. And when everybody's trying to do that, I think that it's kind of like, if we were back in, let's say, 2014 or so, this kind of genie wasn't out of the bag yet. Everyone was kind of still latching on to kind of value investing. And like fast forward 5 or 6 years, and everyone is now going and like paying up for leaders. And I don't know how the next 5 years is going to pan out, because you need the market to continue moving forward to justify a lot of these valuations. And if
you're totally right. Yeah. What I would just say is that this business that this guy wants to identify is those that the larger they grow, the stronger they are. So it's a flywheel effect. And not all of them that you see today with high valuation growth stocks have this particularity, right? The bigger they get, the stronger they get. Costco is an example, right? They want to lower prices to their clients. So the bigger they get scale advantages, they get bargaining power, and they then pass it all to their clients. Not every growth business has this.
Yes, that's a fair point as well. Costco is a terrific business, absolutely. It's kind of interesting because in the case of Costco, it's one of the few companies that seems to have done okay in migrating internationally, even though there's a difference in culture. between China and the US. You know, seems to have done really well. If you look, for example, they've managed to coexist to a certain point. It's still early days, but with JD.com and other retail opportunities, which is really, really interesting. In the case of Amazon, we know very well that Amazon is not doing anything in China. So it's kind of interesting because it's like it should work, but it doesn't work. And it's kind of like, how do you know? Like you look at Mercado Libre, Mercado Libre is quite big in like Latin America. And it's like, why isn't Amazon killing this market? It seems to be like Western leaning, yet it doesn't work. So it's kind of interesting because everyone is paying, like, for example, with Amazon, like everyone's paying such a high valuation and the expectation that they'll kind of keep finding new markets. And like, yes, they are huge, but as you alluded to at the beginning, it becomes an anchor because next year they have to come up with 600 billion of revenues.
But the trick is to find it when it's
like, whoa, 600 billion in revenues is a lot of revenues, man. I mean, yes, of course. Yeah.
By the way, so just so I don't forget, you're talking about Zillow and what was the other one?
Open Door Technology. So I do own Open Door Technology, just for disclosure.
Have you looked into EXP Realty or Realty?
No.
Look at it because it's somewhat like Keller Williams in a somewhat multi-level marketing. The agents earn money by bringing in new agents. So it has some sort of flywheel effect. I haven't invested in it because there are some things that make me uncomfortable, but I researched it. I talked to several agents in Brazil and in Portugal. These guys are growing a lot. It's really interesting, but I haven't been able to get comfortable with it, but you might like to take a look at it.
Okay, so I think that kind of, I think that's wraps up for this week. And thank you very much, guys. And I look forward to seeing you next time.
Goodbye, Michael.